Tonight's discussion, as we look at the hour ahead of us, we're going to focus a lot on just discussing the cattle and feedstuff market. We'll talk about our projections into the early part of next year. We'll review some of the projections that Mike Murphy would have shared with you as well. And then we'll take some time to talk about what our advice is for those of you looking to market not only fall wean calves in 2016, but also talk a little bit about those of you in the meeting tonight that be feeder cattle sellers. And then Ethan Oberst on our team, he'll take a stab at looking at our 2015 cow-calf survey and sharing those results with you, many of you who probably participated in some of those results. And so before we dig into the call and the discussion, I do want to make note of our sponsor, Elanco Animal Health. They've been a great partner with us from almost the beginning on this webinar series, and we appreciate their support of what we do here at Cattlefax and our work in bringing this webinar to both Cattlefax members and non-members alike, thanks to their sponsorship. And so we'll have some words a little bit later on from Leanne Walters with their team, and she'll have some messaging for you, hopefully to help you guys manage your ranches better in the coming year as well. And so with that said, my name is Lance Zimmerman. I think you've heard me before many times on this webinar if you've been a long-time participant of ours. And I'll be giving our market projections today as we talk about what's gone on in the market and what Cattlefax sees going forward. As you look at the market projections, if you attended this webinar back in January, Mike Murphy would have given you our projections for our long-term outlook at that time. And so as you look at this, obviously the 2015 annual averages are highlighted there. And this was the 2016 projection that Mike Murphy would have given you all back in January. And what you can see is as we look through these price series, obviously the biggest thing is as we looked to 2016 early on, we were expecting a pretty big correction in the cattle market prices. But what you'll notice is as you look to our revisions that we would make here almost just through the first quarter, we ended up taking those revisions specifically on the cattle prices even lower. And when you look at the all-fresh retail beef price, very similar, almost identical. Same could be said for the composite cutout, although just a little bit weaker. As you look at these cattle price markdowns, though, especially as you work your way down to this calf price, some pretty significant reductions, and even those of you in the market are selling a lot of utility grade cull cows, a pretty big price reduction to our forecast there as well. And that probably leaves a number of you saying, what's going on here? Why the big revision? As we went through the second half of 2015, Mike talked at length about the factors that led to such a different marketplace shaping up from the first half of 2015 to the second half of 2015. Record high competing protein prices, really underperforming exports, and a building uncurrentness, not just in our fed cattle supply, but even in our feeder cattle supply. And a lot of those same challenges still existed as we transitioned into 2016, which led us to the initial lower revisions on prices going into this calendar year, moving from cycle highs in the cattle cycle to transitioning to lower lows each year. But some of the other things that we'll talk about a little bit later that also are leading to the revision lower on these annual price points are the loss of currentness in the feedlot segment, stretching out a lot longer than even we thought that those problems would linger. The protein supplies, from a competing protein standpoint, continued to remain abundant, and we expected better exports in 2016. And I think as we look at that trade situation in the second quarter of this year, we've gotten to a point where we're very comfortable with a lot of the projections we made for this year back in January or even the end of 2015. But I think it took a lot longer to develop than we would have really expected. And so those slower developing export markets, a continuing strength in the dollar, really held back the robustness in exports that we were hoping for as we looked at this market year. The other side of it that really came into play, specifically as you look at that lower calf price and that lower feeder cattle price, was really the persistent losses in the feed yard segment. They went through a period of time in the last 12 months where they lost over $5 billion as an industry segment, and those losses continue to be extreme, and those losses continue to extend all the way through the early spring. And that not only had an effect on feeder cattle prices, but it kept those sellers of feeder cattle in negative equity territory as well and creeped into hurting the calf market. And so we'll talk about all of these things as we work through today's presentation in more detail and what that means for us as we look to market cattle in the second half of this year. But I think one thing that I want to do is just share this perspective with you. I know this graph is a little bit busy, but I think it helps us all get on the same page in terms of what we mean when we talk about the cattle cycle. And really, when we talk about the cattle cycle, the number one thing that we're zeroed in on is cattle prices. But what we know is those cattle prices fluctuate both based off of supply and demand. And what we talk about when we talk about a cattle cycle is usually this is a 10-year market cycle. And you can see here in the gray, we really started at the beginning of this decade. And we started with what we talked about as record high harvest numbers. The drought combined into that. We had good fed cattle numbers through a lot of that period. But we saw those numbers continue to erode as we worked out of that drought condition, as we continued to see how deep we dug into that feeder cattle and calf supply. And we really got to a point as we got out here into 14 and 15 where we saw our absolute lows in supplies. Likewise, we put our highs in the market at that exact same time. Depending on which market you were selling into and which region of the country, those highs ended up materializing somewhere in the fourth quarter of 2015 or 14 or the first quarter of 2015. But as we look at it and we look at our cow inventory, this base is still growing. Whether you look at the percentage of heifers being sold today as feeder cattle and calves, whether you look at the supply of heifers going into the fed production mix, all of it points to this cow inventory continuing to grow and this peak likely not being met until sometime out here in 2017, likely more like 2018 before we put this peak in inventory numbers. The other side of the equation, which we'll talk about a little bit later, is the break from these price highs. No matter what you look at, 2015 and into early 2016, we saw these cattle prices correct 30%, and in many cases 30% plus from their highs. Very similar to what we would see in a lot of these other major cattle cycle transitions from the highs. And I think the extreme correction that we went through tells us that we're likely closer to this bottom on this price cycle move than maybe we would be historically speaking relative to a lot of these other cycles. And so as we look at this, I think we need to understand that we're going to continue to talk about a growing inventory base, a growing production base long into the end of this decade, with the inventory numbers that we're looking at likely not seeing a peak in production until we get out here to 2019 or 2020. And depending on how all the stars align with supply, with margins throughout the supply segment of the industry, it's not out of the realm of possibility to be talking about 2019 or 2020 actually setting a new record for beef production for those calendar years. A lot of things have to line up perfectly, but that's definitely a situation that's in the cards as we look at this marketplace. As we think about the price cycle, and we can see a number of different cycles in here. You got the early 2000s cycle, you have the cycle we went through in the late 90s putting in the highs. Clearly this cycle that we went through in the early part of this decade was an extreme. But what we also need to recognize is almost as fast as we've gone up, it's our expectation as we work into this 2016 period, we're going to take the bulk of the price decline right off the bat. When you look at the second half decline that we went through in 2015, combined with the market that we're dealing with today, the bulk of the price decline in our minds is already behind us. We're still going to see some lower prices as we work out here into 2017, maybe even 2018. But as we look at this marketplace, we need to recognize that the margin has transitioned back to the end user. The retailer, the restaurant, even the processor has gained back a lot of the leverage that we had over them and a lot of the bargaining position that we had over them as we worked into these highs. As we go forward here, obviously it's put us at a disadvantage, whether you're the cattle feeder, the stocker operator, or even the cow-calf guy, with much tighter margins or even losses compared to what we were used to earlier in this decade. But it's the normal transition that we go through in this cycle that causes us to take our foot off the gas pedal on this expansion phase and start applying the brake. And so as we look at it, though, the reason that we could sit back and talk about the potential that we're actually through the bulk of this break in cattle prices is the idea that when we compare it to other cattle cycle highs, the percentage break that we've taken out of this market is comparable already to even rivaling some of the worst breaks we've ever seen in a lot of these other cattle cycles. You can see here as we look at it, each of the major cattle cycle highs, the late 70s, the early 90s, even 2004, and then obviously the highs we carved out in 14, the current cycle that we're going through today. And what you can notice is, the first thing is, we're only a year and a half into this cattle cycle. You stretch this out and look at the number of weeks in this. Number of these cattle cycles lasted 3, 4 times, 5 times as long as what we're dealing with today. But when you look at the magnitudes that we're seeing right now in this particular cycle, I want to call particular attention to this 1991 cycle. It was one of the biggest breaks that we saw from the cycle highs to cycle lows, and really it equates to a 48% break. And when you think about that, we're already at a 41% break on the current cycle, with prices sitting in here in the low to mid 140s. As you look at this particular pattern and you talk about the futures market that we were trading this week at the lows, basically a 48% break from this 244 high equates to a 127 feeder cattle market on a cash basis. If you go back and look yesterday at the March feeder cattle contract for 2017, we hit this level. Now, I'm not suggesting that the futures market just automatically priced in these lows, and that's the worst case scenario already priced into futures today out in the March contract of next year. Unfortunately, this market's not acting in a fashion that it can be that simple. I think we also got to be very respectful of the timeline that we're on right now, being very early in the typical cattle cycle. But I think what we do need to recognize is that in all likelihood, even futures seems to be looking at an environment where we've likely taken in the bulk of the price declines. Futures is priced in a break that's already on par with 1991's break. We're still months away from realizing prices in that 127, 128 potential area. But I think we do need to at least be receptive of the fact that this market remains fairly depressed on the future side of things. And the cash market's sitting here today in the low to mid 140s. And we're in an environment where a lot of this break's happening faster and more volatile than any of us would have expected. And there's the potential that we could see this market at least recover or at least trade very steady throughout the rest of this cattle price cycle, specifically when you look at some years like the 1970s, where once they priced in the initial break, it was a pretty significant chop for the rest of that cycle until it ultimately priced in the lows that it rallied from. One of the other things that I think as we look at this market that I talked about, and we sit back and say, well, what's it going to take for us to get a rally in the feeder cattle and calf markets in 2016? One of the first places that I think you need to turn to is the source of demand. And the source of demand in the feeder cattle market specifically is the seller of fed cattle. And as you look at this marketplace, and you look at the losses taken on in the cattle feeding segment in blue, and you look at it in exchange for those year-over-year change in feeder cattle prices, it's not difficult to understand when the cattle feeder's making money, he's willing to pass it back in the form of higher stocker cattle prices, higher background in cattle prices. When the cattle feeder's losing money, the cattle feeder pays in the form of lost demand. And you can see here, Mike kind of pointed this out in the January edition of this webinar. They made $5.5 billion from October of 13 to the end of 2014, and they've given it all up and then some in the 12 plus months that have existed since. And so as we think about feeder cattle prices, demand was certainly not our friend as we've looked at this marketplace and the influence that the feed yard equity drain has had on this marketplace. And then in addition to that, which we talked about in January, is this industry was looking at an extra 1.3 million head of cattle outside of feed yards on January 1 that had to be placed into cattle feed yards. Placements have actually, even as depressed as they were the first 3 months of the year, they actually did a really good job from January through April of remaining very on par, very on pace with the available supply of feeder cattle that were outside of feed yards. And so as we look at this marketplace, it's no wonder that we broke the seasonal trend, where we get used to seeing a market that starts to rally in March and usually carves out its highs out here in August. That's really been stale ever since that point, and the downtrend has continued through that marketplace. As we look at this today, you can see that as we get to this April period, we finally have cattle feeders that are seeing some profits. I'd argue that the give and take that you see there is they're operating really around a break even over the last 30 to 60 days. But this is good news that you're starting to see this trend change. And as we work into the summer months, if this cash market can maintain some premium to the underlying futures contracts, we can maintain a situation where the cattle feeder is going to make some money through this summer period, and hopefully we'll see some better support to feeder cattle prices into that summer window like we're used to. Now, what does that price point look like? I think if you look out here, our spring highs were back here in the low 160s. As we look at this from our standpoint at Cattlefax, we're not going to be talking about cattle feeders being flush with cash as they get into this summer period. There's a lot of balance sheets that need healing as we look at that industry. The other side of it is we still need to realize that while we chewed into a good chunk of these 1.3 million extra head, that there's likely still some more cattle out there that are going to be placed into this summer window. And so because of that, while we see a recovery happening in this feeder cattle market, we don't necessarily see it being overly robust. Probably looking at a market that as we reach out to these August highs is going to get back into the low 160s area, but anything better than that's likely to be as good as it gets. You know, if we get anything above that, it's really going to be an opportunity for feeder sellers to dig in deep and be aggressive with marketings, in our opinion. But one of the interesting things is whether you look at the fed cattle market as a seasonal market where it puts in its traditional summer lows, more of a contra-seasonal market where it puts in its lows in the first half of the year and rallies higher in the second half of the year, or even a situation where you look at feeder cattle markets in years following big equity losses in the feed yard segment, all of them move higher through the summer on average. It's not a given that it's going to happen this year, and I think we realized that with what we went through last year. But as we look at this, there's at least some reason for some cautious optimism as we work into this summer period, that potentially the lows we put in April are in the past. The calf market, very much the same situation. When the fed cattle market, when the sellers of those fed cattle, whether they're stockers or backgrounders, are losing money, calf prices break. As we look at it, it's the same situation from a demand standpoint. Same situation from the supply standpoint, although supplies in this period usually aren't too burdensome in the calf market. Buyers are struggling to find calves to fill up those pastures that are greening up in that period. But what we do know is as we get out into this period in October, November, and early December, supplies aren't going to be an issue. Supplies are going to be abundant, and sellers are going to use that to their advantage. And so as we get into this fall window, Cattlefax fully expects these calf prices to continue to make a recovery as we work into this summer period, as supplies naturally tighten up and lift that market. But then as the additional supplies start coming with fall weaning, we're going to see this market break back down. And likely you could have a market that develops a very range-bound pattern all the way through the second half of this year, carving out price highs under $2 in the summer with a peak probably in that late summer period. And then as the supplies start coming, as fall gets introduced, revisiting some of these lows we saw earlier this spring are a definite possibility. Another challenge that I didn't talk about earlier is the disconnect that's been in this futures market. Even though Cattlefax revised its fed cattle price lower back to that 130 target, futures today, when you use the average of prices that we've seen through mid-May and then look at what futures is implying out to December, is pricing in a much more bearish situation. And what we have here is annual Fed prices on the left-hand axis, and on the bottom axis, what we have is U.S. per capita beef supplies. And so what you can see is that inverse relationship between price and supply. And what you can see is this line that goes from the upper left to the lower right really is kind of what you could call an average demand curve. And you have years like 2014 and 15 where we had exceptional demand, and those years are far up and to the right from the curve. You have years like our recession years of 9 and 10 where those dots pulled down and to the left from the curve. Well, 2016, as we got it forecasted today at Cattlefax, is really based on demand that's very similar to these other 3 years, just prior to the extreme years that we put in 14 and 15. Futures, when you really look at how far it's pulled back from the line, is implying that we're going to have recession-like demand levels. Today at Cattlefax, we don't buy that. We don't believe that that's the case. But we also got to be respectful that the futures market's job is to tell us what it thinks out going forward. And the futures market sits back today and it sees that from those 2014 supply lows, coincidentally also the price highs, that we're adding back 2.3 million head of supply as we get to the end of this decade. And the futures market wants to assure itself that this market has the demand to handle that type of a supply base longer term going out through the end of this decade. And I think it challenges us as cow-calf producers and stocker operators to really sit back and ask ourselves the question of what steps are we taking to make sure that we're differentiating our marketings throughout this period? What steps are we taking to make sure that as this supply grows and there's more competition for those buyers' dollars, what are we doing to make sure we put more of those back in our pocket? Some of you might be saying, well, if the market's concerned about demand, what does demand really look like today? This is the all-fresh USDA Retail Beef Demand Index. The USDA publishes a monthly retail price. And what you can see here is we got 2014 and 2015, which we know were extreme demand years. Some of our best demand years since going back to the early 2000s. We had the benefit of the Atkins diet and some of those things really pushing demand higher. And what you'll notice as you look at this is we're sitting in a situation where we're nowhere near the demand levels of 2009 and 2010. In fact, if we were talking about 2009 and 2010 demand levels, they would have been plus or minus right here around this 102 level, where 100 equals the demand we saw average across 1998. And so demand is playing out very much like Cattlefax expected. We respect the fact that there are recession concerns out there in the industry today. We fully understand that, but at the same time, it's not an economic downturn yet. And in fact, some of the indicators that we would look at, whether it's consumer comfort index, consumer confidence index, or even the stock market, suggest that it's going to be a slow growth year. And it's going to be really tough to see year-over-year GDP growth all the way through 2016, but nothing to the standpoint where it should concern us today with significantly weaker demand. And so I think as we talk about what this all means for our marketing perspective, what does this mean whether we're entertaining forward contracting or retained ownership or video sales, the same things that we've told you over the last year still exist. We're still making a transition on the downward side of this cattle price cycle. As long as that's the case, we need to be recognizing that every single year means we're selling into lower seasonal highs and lower lows. And I don't think that's a shock to us today. But what that means is we think about our marketing perspective, even with all the unknowns in the marketplace today, even with the discount we're seeing in the futures markets, our best strategy is still marketing these cattle early. It's no fun. It's challenging doing that in a market environment that is like it is. But forward contracts, video sales, and even figuring out what opportunities exist in the futures and options market, which this one's likely less popular today than it would have been for us 6, 8, 10 months ago. But as we look at it, our best opportunity is still likely in front of us. As we look at the corn market, we do think that as you look out to that new crop corn, the December contract that's likely going to have the biggest influence on feeder cattle and calf values going forward, we priced in an awful lot of increase here from the first part of March into current day. But as we go forward, that corn market's going to continue to be more friendly to us. Right now, corn prices on a futures basis right around that $4 area is the top of the range. But we're getting into that point in time where we're going to start trading new crop news. We're going to start paying more attention to the rains that are happening across the Midwest. And we do think that there is some weather concern as we look into that corn producing region in July and August from a heat perspective, but moisture should remain strong. And so as we look at this, again, that projection on one of the very first slides was a 365 futures price average for this year, with a full range of $4, actually $4, I believe, and 15 cents, all the way down to a potential harvest low of 285. And so as we look at this marketplace today, a lot of the bearish news from a corn market perspective relative to the cattle perspective that we're looking at, the pressure that could be placed by higher corn prices is already there. The corn story is likely going to be more supportive to the calf and feeder cattle market going forward over these next few months. Again, keeping in mind that by late summer there could be some news that props up these corn prices and is a little more bearish to the calves. On the corn and hay side, again, these two markets correspond very close to each other. As you look at this was a pretty significant break, obviously, we went through on the corn market side of things. Obviously, taking those prices and eroding them 60% from the highs to the lows. The correction we've gone through in the hay side, whether you grab it from that high or the one that would have been last spring, is only a 30% correction. But longer term, we need to be looking at hay prices finding a bottom, likely somewhere on this all hay price index across the U.S., closer to $100 a ton. The extreme weather conditions in California and the western third of the United States are keeping hay prices pretty elevated out there. But we expect as they get better weather relief going forward, we're going to continue to see those hay prices break down and come back in line across the country with that long-term support. Again, this is including all quality types of hay as well. So your region of the country could be considerably different, but just trying to give you a picture nationwide. And so as we look at this, you say, okay, Lance, Cattlefax, why should we be concerned with selling earlier? The biggest thing that we can tell you is when you look at this marketplace and you look at these video sales, which still represent some of our best data in evaluating the benefit of selling out front versus in the delivery month, 5 out of 7 years, the producer has been better off selling early. And what you have here is the black bar represents the video auction price through that summer period with a fall delivery window, compared against the actual cash prices in that delivery window. And what you'll see is a couple of years will stand out to you where that advantage was inversed or maybe not as strong as it normally was. 2014, you were actually better off selling in the fall, delivering in the fall. Same with 2013. And then 2011 was one of those years where it was about a wash. In those 3 particular years, as we look at it, each and every one of those years, the market uptrended all the way through to the end of the year. Cattlefax is not expecting that today. It's a possibility in a year where maybe we have something contra-seasonal go on, but right now we can't call a market like that. There's just not enough information there for us to make that call today, and we're still operating under the assumption that it's a seasonal year until proven otherwise. We may wake up in July or August and the market looks totally different than it does today based on the margins that exist in the retail and processing segments, but we're not there right now. And so as we look at this marketplace today, it still tells us we're better off selling early. And then if we have a little jingle in our pocket, if we have a little bit of concern that this market's going to get away from us and rally higher and we already sold our cattle, maybe we look into some situations where we buy some call options so that we're not hurt if the market turns lower, but if we're holding those feeder cattle or live cattle call options in some of the deferred contracts, we can at least capture some upside even though we already sold our cattle early. On the feeder cattle side, the benefit's a little more negligible, but we also need to recognize that we're comparing summer video auctions that are delivering only maybe in the spot market, maybe only a month or two down the road compared to their cash price. But even that said, 3 out of 7 years, there was an advantage selling these feeder cattle early, and the advantage was considerably less than the calf side of things, but still a $12 a head advantage. So as I wrap up, before I hand the reins over to Ethan, supplies, right now we're in an expansion environment. Feed yards are placing more cattle right now. We're increasing production year over year, especially as we look at April and May. We're likely to see pretty big year-over-year gains all the way through the summer before those gains narrow but still remain larger than 2015 into the end of the year. Demand, the market's not talking about the relatively strong demand that exists today. Again, better than 2014 right now in the early part of this year. Not as strong as 2015. Exports remain a concern, but a lot of those tides are turning. The strengthening dollar will be weaker, will imply weaker exports across all commodities, but we're optimistic that beef can maintain some of the momentum that it's gained here in the spring months. The fed cattle market, it's been a cash-led market all the way through. We expected the spring highs to hit right in the area they did. Thought maybe they could get $1 or $2 higher than they did, but we still were dealing with some currentness issues that cut that market high short. And we're not expecting the fall highs that we typically see out in November to approach or surpass really what we saw this spring at 139. The fed feeder cattle market, we expect a seasonal rally, but it's likely going to be flatter than in recent years. Again, likely carving back into the low 160s range for a top as we get out into the late summer months. And the spring futures highs may have been our best opportunity to hedge those cattle. As we look at it going forward right now, it may be very difficult for those deferred futures contracts and summer contracts to gain a lot of traction. Calves, the data suggests selling early is still our best option. You know, corn prices are going to move lower. We understand that. But again, as soon as we start getting the bulk of this planting news priced in, you could see those deferred contracts really give up the premium that's been built into them pretty quick. We look at it and we sit back and say that it still offers us flexibility to sell those cattle early and still build in some kind of risk management strategy if we see this market turning higher in the second half of the year in a significant fashion. And a lot of times these buyers, they're going to be looking for the better quality in these forward sales. As they get more into the spot market in the fall, they're probably just looking for head to fill pen space. So if you have higher quality cattle, you're likely to see a better reward for your premiums into that window. As we think about this marketplace and we think about the risk to marketing these calves in the fall, we know we're going to walk into additional supplies. And so as a cattle producer, we're still of the opinion that selling early is our best option. I know a lot of folks out there today are looking at retained ownership as a tool. But again, when you're selling into a market where every single year until we break this downward cycle creates lower highs and lower lows, increasing your length of ownership typically works against you. Because the longer you're owning those cattle, the more difficult it is to catch a significant uptick in the market to make that business move pay for itself. And so as you look at this, staying very short with your marketing window typically is a more profitable strategy on a downward turning market. Be sure to put your questions in the chat window. Ethan and I will be keeping track of those, and we'll be happy to answer all the questions at the end. Type them in there, and we'll keep track of them, and we'll answer those questions at the end. But Ethan, if I can, I'll turn it over to you.
Thank you, Lance. Sorry we had a little bit of technical difficulty right there, but appreciate it. Also want to thank everyone for joining us this evening. As Lance alluded to, I was going to get in some of the analysis that we've done on our recent cow-calf survey here for 2015. This is something that we've kind of brought back. We've done it in years past. We brought it back as a service to you all, and hopefully it does provide some value. So getting started here. Just some disclaimers about our Cattlefax survey. It was a survey sent obviously to cow-calf producers. It was a multiple choice survey, so some of this data can get a little bit lost in the multiple choice answers, but we do feel very confident in the answers that we received, and I just kind of wanted to lay that out there. Looking at the kind of the average data or the national data, there was a weighted average of about 240 cows per return. That is the kind of the data that represents is about 240 head. 71% of the returnees or of the answers were spring calving operations. That means basically I did include a January calving date in there as spring calving, as many of the southern producers would consider that as a spring calving herd. Also looking at the calving interval, so that's not a very descriptive term there, but 78% of our answers or our returned surveys said that they had a less than a 60-day calving interval, and I was quite impressed with that. That's be under 60 days. That's basically two and a half cycles or heat cycles for each cow. That is pretty good. I am impressed with that. Weaning weights, steers had a 566 pound average. That's about what you would expect. You include southern, southeastern, as well as northern influence in there, and that's what about the averages you're going to come out with. Heifers are obviously a little bit less than that, weighing in at 525 pounds. The national average calf crop of the survey was at 88. You could call it 89%. Also, that is a pretty good number when you kind of look at the full spectrum of the surveys and full spectrum of operations. 89% is doing quite well. Marketing avenues. We still have about 50% of producers selling in the cash market. Obviously, that's mainly the sale barn. We also included in that is for immediate delivery. So private treaty for immediate delivery is also included in that. Other video sales, internet sales, anything for out front delivery. About half of our respondents sells in that kind of a marketing avenue. Also, about half of our respondents also said they retained ownership of some sort. That could be through a backgrounding operation, through winter grazing, summer grazing, or even the feedlot. I was a little surprised at that, but that is a good number and a way to increase value. The average cow cost, or the weighted average cow cost, cash cow cost. The way that I looked at that is basically everything that doesn't include depreciation and return to management. So that's just kind of cash cow costs. What you are paying out of pocket, pasture, feed, day help, things like that of things that you're paying out of pocket or paying up front. Average calf revenue was obviously still very strong. Even though we had quite the severe break in the second half of 2015, the average weighted average calf revenue was just under $1,300. Getting into a little bit more of the data, I kind of wanted to provide some analysis for you all from a high, average, and a low return producer. I sorted this data out, so basically to look at profitability only. That could be a high return producer could have sold calves for $1,800 a head and had a $1,000 cash cow cost, or it could have been a producer that had a $1,200 calf revenue and a $400 cash cow cost. So I just looked at the profitability from what the survey respondents kind of said, and sorted the data and let the data speak for itself. And as you can see, as going through some of this data here, you can see what kind of responses we got, and the tendencies between the high, the average, and the low return producer. Pertaining to this data, the low return producer was any operation that made $500 per calf or under. Average was $600 to $700, and high return was $800 and over. Now, I know you guys are sitting out there and looking at that, and that's saying, how is a low return producer 500? Well, I measured off based off of the peers for the same year. Obviously, for the majority of 2015, we had a very, very strong calf market, and that played a major role into how I sorted the data from high, average, and low return. So looking at this slide here, obviously you can see, I kind of alluded to it earlier, majority, the shorter the calving interval, the heavier calves are. Kind of the old rule of thumb of 2 pounds per day of age of calf. Well, if you shorten that calving interval up, or that calf, your average calf is 15 days older, that is going to be an extra 30 pounds heavier that calf's going to wean at. And I think this next slide, definitely explains that. But as you can see, a larger portion of our low return producers had plus 90-day calving intervals, and as you can see here, a larger portion of our high return producers had a shorter calving interval. And as you can see, it's still very good data. Most majority of them were in this 45 to 60 day window, or I should say under 60 days for their calving interval. This is the weaning weights based off of that calving interval length. So this is the data sorted for everyone that answered what the majority of their cows calve, or how many days. As you can see, this 0 to 45 days, or under 45 days is the majority of their cow or calves. Their weaning weights are above average. You can see here both, really, if you're under 60, you're doing well. And you can see the decline here. As we get out to plus 90 days, majority of the time, you're going to wean all those calves within a 2-week period. If you have a 3-month calving interval and then wean in a 2-week period, you're going to have quite the variation. Not just a reduction in weaning weights, but also the variation uneven calf crop. So the shorter we can tighten up that calving interval, not only from a uniformity standpoint, but also from a weight standpoint, it's obviously beneficial. On to the next slide. Looking at the average, low, and high return producers from the weaning weights. The blue lines are the steers, and the orange lines are the heifers. As you can see, there's quite a bit of difference, and it makes sense. The more weight you can wean per steer, or per animal, I should say, the more you're going to have return, the better chance you're going to have a larger profitability. And I'm not saying that you go out there and chase solely weaning weights. Yeah, you got to do what works best for you. Obviously, one of those things is tightening your calving interval can obviously change that. And as you can see, though, there's not a whole lot of difference in profitability for guys that are chasing, those really extreme weaning weights. I think as you chase that extreme, or that maybe that too much, or that maximization of your weaning weights, you start to increase your cow costs to the point of where it's a 1-to-1, and it doesn't have as much of a return or bang for your buck in increasing those weaning weights. Heading on the calf crop percentage, I think this is something that is really important and really stands out to me. Looking at it, if you have a $600 cash cow cost and a $1,200 calf, every 1% counts for $18 a head on your calf. So the difference between here, if we just round this down and call this 90, call this 87.5, that puts us at 2.5%. A difference between the high and low return producer, and that equals $45 a head that we're missing out. I think this is more important, right now as we kind of make this correction in this calf market. I think that's the difference between being profitable and not being profitable here in the years to come. That anything that's from fertility of our bulls, managing our bulls well, even down to getting breed soundness exams on our bulls. That's something very important. Also looking at the fertility of our cow herd, nutrition of our cow herd, and then obviously the health and vigor of our calves after they're born. Those all play a factor in our calf crop percentage, and that's a huge difference. And as you can see, 2.5% may not sound much, but $45, $50, $60 a head extra in a calf is definitely something that we can, I think we can all be happy with. Going on here, also looking at some of these marketing avenues. As as we looked at earlier, the blue lines here are sold right off the cow. That basically no weaning process, no retained ownership, nothing along those lines. The orange lines are something that we, either from a backgrounding operation, whether that's 45, 60, 100 days in a backgrounding operation, that's also through winter and summer grazing operations. And then the silver lines are retained through a feedlot. Obviously, that has a lot to do. Profitability of these, some of these are projected profitability because we're just now 2015 calf crop, just now coming out of the feedlots. Some have not even come out of the, still just now entering the summer grazing program. So that's some of the projected. So we got to take that kind of, with a grain of salt there. But as you can see, these, the higher return producers took their calves somewhere. They did something with them to add value. And I think that's a take-home value or take-home point here off this slide is to do something with your calves to increase their value of those. Whether that's just a weaning program or 45 days, obviously there's VAC 45, VAC 34, some of those programs that we can do to increase the value. Looking at some other nuggets that I pulled out of the cow-calf survey. Obviously, this has a lot to do with the calf market in 2015. But as you can see, this is for out front delivery of the video, video internet sales, and then this is for immediate delivery, basically auction barn and direct trade for immediate delivery. And this is the percentages are obviously, as you can see, kind of the weighted, but I'm looking at this weighted calf, revenue. Obviously, this is a huge, point of the 2015 calf market where it made a very steep decline into the second half. But as Lance kind of alluded to, that was something that these producers that sold out front did protect themselves from. As you can see, there's basically $130 more, room to work with in these cows that were sold out front. I think I wanted to bring that to attention. Those calves may have a little bit higher value, as cattle that are sold in auction barn. Obviously, maybe more of a commodity calf. Not saying anything's wrong with that. Just fits your production operation. But as you can see, there's $140 more to work with per head there. Also, another thing I wanted to, something that stuck out to me. On the top here, operations that had an average bull price under $7,000 a head for a bull, and then operations that had over $7,000 a head per bull. And as you can see, the producers that spent more money on their their bulls obviously got more of a return from there. We're looking at about $110 a head more for operations that spend a little bit more on their bulls. Probably have a little bit higher genetics, more of a reputation, from a reputation breeder, somebody that they can put in the description on the video sales. Maybe something that they can do in direct trade, saying this is the type of Gen X, and the calf user knows how those cattle perform. I think that is something that is very important to the calf user, whether it's a grazing operator or a feed yard. They do care and predicted performance and obviously optimum performance. So I think that is something very important to the calf user. On my last slide here, I just wanted to kind of point out something here it's pretty it doesn't seem like it needs to be pointed out in 2015, but it does. Looking at here, operations that have a vaccination program in place, and look at their weighted average calf crop percentage. Like I said, this is a difference of about 2.5 points. Again, that is $60, $45 to $60 a head. Difference between operations that have vaccination programs in place and operations that do not, and I think that's something that as we move forward, we need to improve on. I don't know many vaccination programs out there that are costing a producer or operation over $60 or $45 to $60 a head per calf. I think most guys can get it done, 25 and under, at any given day nowadays. So I think that's something I definitely wanted to mention. That's money in your pocket. The more we can increase that calf crop percentage, and just by a few shots, obviously that's that's from a cow standpoint. I know there's some operations that just don't have the facilities, don't have the operation to get that done, but I think there's a lot of room that we can actually improve in there and improve our bottom line. With that being said, I am going to pass it on to Dr. Leanne Walter. Hopefully she can get connected here, and hopefully that we have no problems with her and her audio. She is an associate senior technical consultant for Elanco Animal Health, and I appreciate you guys spending time with us this evening, and I hope that you stick around and listen to what she has to say. Thank you. Leanne, it is all yours. Are you around?
Can you hear me?
Yes, ma'am. Sure can.
Perfect. Well, thank you both very much. I just want to continue on with the conversation and the interesting data and present you with some studies that were done looking at both ferments, which is an ionophore, and component TG with Thailand, which is an implant, and looking at the data when they were simultaneously used in stocker cattle with respect to the return on investment. So this slide there's a lot of data on this slide, and I just want to walk you through it. There's 3 different studies that were done, the first at Oklahoma State, the second University of Arkansas, and the third at the Noble Foundation. This were stocker steers, different stocker days, 112 days in the first study, 87 days in the second, and 84 days in the third, all sterile pastures, seeded to cereal pastures. So the way that we're set up is cattle are randomly assigned to different pastures, and within a pasture they were supplemented. So within the Oklahoma State University study, the first trial, cattle either received an energy pellet or they received energy pellet and rumensin. And then within each pasture, cattle were either given an implant, a component TEG with Thailand, or they were not given an implant. So this allowed us to look at what the impact of rumensin was through an operation and look at what the impact was with an implant to an operation, and then what the additive impact was as well. So rumensin intake in the first study was 200 milligrams per head. Final body weight was improved 19 pounds with rumensin. With an implant, it was improved 35 pounds in these stocker steers, so the additive response was 54 pounds. So very significant when we're talking about things we can do to improve our bottom line. The University of Arkansas study saw we used mineral and rumensin package, and then a protein block and rumensin package for the stocker steers. Average daily gain was improved with rumensin by 18 pounds versus just a control mineral package. And with an implant, that average daily gain was improved, and with the additional weight, it was 22 pounds. So the total additive response for the University of Arkansas study was 40 pounds. And looking at the last study, the Noble Foundation, which was done in Oklahoma, they had a rumensin intake of 74 milligrams per head per day. Also found an impact on average daily gain with rumensin. So looking at a 31-pound additional weight gain with rumensin and a 39-pound additional weight gain with an implant. So the total additive response in that trial was actually 70 pounds, so a very significant weight gain. The results of these 3 trials have found that rumensin and component TG with Thailand or an implant gives you anywhere from an additional 40 to 70 pounds at the end of that stocker period. Just to summarize those trials, there was no significant interactions between supplementation and implant treatments at any site, which means that they have different modes of action. So one's an ionophore and one's an implant, and the effects of the technology are essentially additive. So rumensin gives additional gain, and then an implant gives you additional gain on top of that. Rumensin supplementation specifically improved average daily gain anywhere from 6 to 15%, delivering 18 to 31 pounds of additional body weight. Implanting stocker cattle with component TEG with Tylen significantly improved average daily gain 13 to 23%, delivering 22 to 39 pounds of additional pounds. And just to quickly touch on this, one of the things we commonly hear both from a suckling calf perspective and a stocker steer perspective is the impact that implanting traditionally has been thought to have a negative impact in the feed yard, whether performance or carcass characteristics. There's 4 different studies that were done where stocker steers were implanted in the stocker phase, then they were brought to a feed yard. They were implanted at the feed yard as well, and then looked at what the impact that an implant had in the stocker period on subsequent feedlot performance and carcass characteristics. So the first 3 studies, or the first 2 studies specifically, were done in Oklahoma. They found 35 pounds of additional weight gain in steers that were implanted in the stocker phase. In the feed yard, when they went to the feed yard, there was no impact on average daily gain for the second study. It tended to be slightly higher in the first study, with final body weight being greater. Carcass characteristics, hot carcass weight was greater, yield grade was impacted, overall marbling score was not impacted. The third study was done at Texas A&M. Grazing phase improvements in final body weight, there was a 32-pound advantage to those steers that were implanted in the stocker phase. No impact on feedlot average daily gain. There was an increase in body weight, final body weight, and carcass weight was also greater. McMurphy in 2013 was done at OSU. Those steers were implanted twice in the stocker period. They gained 55 pounds in the stocker period, but overall feedlot performance was not impacted, hot carcass weight was not impacted, and in this case, while overall marbling score was not different, upper 2/3 choice did drop slightly with quality grade. So 3 of the 4 studies would have found 32 to 35 pound advantage to implanting in the stocker phase, and a greater body weight when those cattle were finished in the feedlot, and a greater hot carcass weight. So we're literally adding pounds throughout the system. We're adding pounds in the stocker phase. We can capitalize on that. And then those pounds continue. Animal is essentially heavier than its counterparts that were never implanted, and they're going to be harvested at a heavier endpoint. So just to summarize, pre-feedlot implants delivered significantly more pounds during the grazing period at all 4 study sites over non-implanted controls, with improvements in body weight ranging from 32 to 55 pounds, so very substantial increases in weight, no negative impacts to performance or carcass quality traits, improved feedlot final body weights and hot carcass weights in 3 out of 4 studies. And just one last slide, stacking rumensin and component TEG with Tylen simultaneously in stocker cattle delivers 40 to 70 additional pounds of body weight per steer to market. So very, very substantial when we know that pounds drives our return significantly. And so capitalizing on that is critically important, especially in a year like this. Thank you.
All right. Thank you, Leanne. We appreciate Elanco's support of the webinar and appreciate your input in today's presentation as well. So as we mentioned earlier, we do have time for some questions here at the end. A few folks have put those down towards the bottom, and a few folks adding some as well. So we'll take some time to do that. We're going to run just a little long, but we also took just a minute to get the technology going right. A good set of questions from a handful of folks. A lot of focus more on things outside of the realm of this presentation, more on the feed yard and packing side, but we'll touch them just real quick. At what time do we anticipate packer basis to widen back to historical levels going forward? I assume you mean packer margins. I believe that's what you're saying there, but as we look at packer margins, they're extremely wide right now. You look at them; they're making $100 a head or so right now, as they've been able to maintain some bargaining position over the cattle feeder. We do anticipate those tightening up in here as box beef prices narrow up after this Memorial Day window. But until we get into a situation where the cattle feeder's in a better front end supply situation that continues to improve as we work through this spring, we should expect to be in a situation where we're more towards the historical low end of that percentage of the cutout that we're capturing there. Another question, what price level do we expect fed cattle to carve out a summer low? That's a great question. If you're paying attention to your futures prices this week, they would say we'd have summer lows down into the low teens. Again, we feel very confident that those type of futures levels are recession level type prices. We do think that carving out some summer lows, probably in the upper teens to low 20s, low 120s is what's possible as we look at the market today. We talk about corn price projections, cost of gain based on our corn price. Really, you're talking about a full range of probably the mid 60 cents a pound upwards of mid 80s. Really is the type of range that we're looking at for the feed yard cost of gains based on that corn price. And marketing calves, what do we consider early? Basically, traditionally, when you're talking about calves, it'd be that summer marketing window for those fall wean type calves. Looking at any window that's probably 3 to as much as even 5 or 6 months ahead of delivery. Ethan, a question for you. Percent calf crop on first calf heifers, was that data in the survey?
It was not specifically. How I worded that question in the cow-calf survey was all females that were included or exposed to a bull or AI, and then the calf crop percentage. I do believe that there was, some areas, some operations that, typically, have more or larger percentage of first calf heifers. They had a little bit lower calf crop percentage. Specifically, I cannot answer that question because that's not the way the question was answered. Obviously, as any of these questions, if we do have more questions out there, our emails are up on the screen right now. And you can be more than happy to, or more than willing to email us, and we will respond here over the next couple of days. If you do have questions for Leanne, I see a couple of those coming up. Please email us as well, and we'll definitely forward those on to Leanne, and I'm sure she will be obliged to answer those as well.
Leanne, are you still on the webinar right now? There is one question that I think you could address pretty quickly without cutting too far past our hour. Are you still on the phone connection?
Yes, can you hear me?
Yeah, we can. Somebody asked when were those pre-feedlot implants put into calves? If you happen to remember that study, how old were those calves at that time?
Yeah, a good question. So those were stocker questions, or stocker calves, I should say.
Okay.
So about 6 months of age.
Okay, great. One of the participants answered that the same way. I just wanted some confirmation there. Some questions about the bred heifer market going into summer and fall. Very, very similar to what we looked at probably in the fourth quarter of 15. You're going to be faced with a very similar calf market in all likelihood. And those prices, as we get into that window, tend to come under pressure in that window. And so if my memory's fresh, it's been a little while since I've looked at that, coming off of our seasonal highs here, typically in that March window. I believe we were talking about a U.S. average. And again, we know there's a huge range about those prices based on quality and region. I want to say we were in the $1,600 to $1,700 price range on a lot of the bred females across the country at that time. You're probably going to see it break down $200 to $300 on average into that window. So with that, I know there's some more questions coming in, but we do have record of who's asking those questions, and we will follow up by email with everybody for those that we didn't answer and get back to them. But we thank you for your time this evening. Appreciate you taking the time to be a part of this webinar and that you trust us with your market information. And do want to share with you the upcoming dates. We do have some seminars coming up, a risk management seminar in September, a corporate college in July, and our annual Outlook and Strategy seminar the Tuesday and Wednesday that would follow Thanksgiving, right there around the end of November. Our next Trends webinar, if you want to put it in your calendar, will be Wednesday, August 31st. We always take off in the summer because we know you have better things to do around your operations, more pertinent things to do, checking calves, working fields, fixing fences, than to sit in front of a computer in the evening most times. So we'll take the summer off as you guys work hard, and then we'll get right back to it at the end of summer, start of fall with another webinar. Probably focused a lot on some of the fall strategies and things you can be doing through the winter to enhance value on your calves. So with that, thank you. We appreciate your time and have a great summer.